Pretty much every deal, 6 assets in 2023, had some type of interest rate pressure.
Today's guest, Zach Haptonstall, is the CEO and co-founder of Rise48 Equity, which has completed over $1.93 billion in total transactions and purchased over 7,400 units since 2019. How are you confident that you're not overpaying for the assets?
We realized, hey, we've got like a 6 to 12 month window here to enter what has historically been one of the most, if not the most, competitive multifamily markets in the country.
He recently did an $11 million multifamily deal, despite historic obstacles in the market. Today, we're diving into how he did it. I know a lot of people claiming that you've scaled so fast and that's not sustainable. What is your response to that criticism?
I'm Zach Haptonstall. I'm the CEO and co-founder of Rise48 Equity. We are a multifamily investment company, and so we're based locally here in Phoenix. We look for value add deals, typically 1980s vintage assets, at least 100 plus units. This is workforce housing demographic, so clean, safe communities where the majority of the population lives. And we'll go in there, buy these deals, renovate interiors, exteriors, increase the value, and then sell or refinance them. And so we're completely vertically integrated. We have our own property management company. We have our own construction management company, and we can control our supply chain. We buy all materials directly wholesale through a manufacturer. And so we've got over 230 plus full-time W-2 employees. We recently expanded to Dallas, Texas. And so we have an office in Dallas. My wife and I bought a second home in Dallas. So I'm in Dallas every 2 to 3 weeks or so. And we've got about 20 to 25 full-time W-2 employees in Dallas right now. And that's the exact same platform, same business plan as Phoenix. So going forward, we're just exclusively focused on Dallas and Phoenix. Since we've started, we've purchased 44 different assets, over 1.7 billion of real estate, nearly 8,000, I think we're like at 7,900 units. We've gone full cycle, executed the plan, and sold 11 of those deals. And so that's kind of a little bit, about us and what we do, and kind of, how we got to where we are now.
That's awesome. And I do want to dive into your unique approach to investing and underwriting, and also just like the awesome success you've had, and particularly a deal that you recently closed on. But first, I wanted to provide a little bit of context because I think it'll help inform a lot of the questions I'll ask you moving forward. But the Federal Reserve has been artificially increasing interest rates, and they haven't done that in a while. It's been described as the Fed's toughest policy since the 1980s. So I wanted to start there. Can you explain what has been happening with interest rates from your point of view, and what you think this means for multifamily real estate at large?
Yeah, absolutely. So yeah, basically, like you said, in March of 2022, the Fed started the first of what I believe were 10 consecutive interest rate hikes. So they increased rates by over 500 basis points, which was, like you said, current as the most drastic, aggressive increase in over 40 years in this short amount of time. And so what that's done, it makes debt service shoot up. Values are down at least 20 to 30% from where they were the first half of 2022. Transaction activity has slowed significantly just because most sellers don't need to sell right now. Like for us, we've told investors we're not going to sell anything all year. There's no reason to. I'm not going to sell a deal in the short term and give a buyer a discount just to sell the deal early. We've purchased now 6 assets in 2023. And I think pretty much every deal, with the exception of maybe one, had some type of interest rate pressure or distress where they had like a loan term coming up, an interest rate cap coming up. They had maybe Freddie Mac floating rate debt where Freddie Mac was sweeping all their cash flow into an escrow account to prepare to buy their new cap, where they weren't renovating and increasing NOI high enough to be able to qualify for a refinance. And so yeah, it's obviously had a major impact on commercial real estate in general. I mean, the office sector is just getting crushed right now. There was news this week. I think, a big private equity firm just, handed back the keys on like 19 hotels. So I think office hotels are getting hit hard. Multifamily is obviously getting hit hard as well, not to that degree, but it's all based on, how you structured the debt, and basically what your business plan is, because there's different types of multifamily strategies too. So yeah, happy to kind of talk about all the effects, what we're seeing in the market and what our strategy is operationally, and as far as like acquisitions, dispositions, and our philosophy there.
Absolutely. And I know people are saying, like, relative to the COVID interest rates before, during COVID, they were artificially low. And so this is high compared to that. But in the past, I've heard you describe how, like, yeah, but it's relatively to other historical periods, it's not even that high, these interest rates. I believe the all-time high was in the 30-year fixed rate mortgage reached the 18.63 in October of 1981. And so I would love it if you could expand on that just to provide more context of what we're really experiencing right now.
Yeah, absolutely. And I'm by no means an expert on interest rates or historian on interest rates either. I've heard people say, well, these are actually a lot lower still than it has been historically, but that doesn't tell the whole story because, you know, single family homes in like top markets weren't 4 to 500K at that time either. Maybe they're like 100, 150K. And so everything is more expensive right now just because of natural organic inflation over the decades, 4 decades since the 1980s. And then most recently, you have this drastic spike in inflation the last couple of years. And so, it's not always apples to apples when you're saying, well, interest rates are still low historically speaking, because when everything is more expensive due to inflation, you have less purchasing power. And so every increase in the interest rate, has more of an impact. And there's more sensitivity there when things just cost more. And so, yeah, I think when you try to compare different eras of interest rates, it's kind of like trying to compare, like basketball players of their era, right? It's like some people are going to say Michael Jordan is the greatest ever. Some people are going to say LeBron James. And it's tough because they're not competing against each other in the same era. There's different competition. The rules of the game are a little bit different, the way they referee the game. So, yeah, I think that you have to kind of take it in context. And again, I'm not a historian, so I can't speak to it. I think that that's just one thing to keep in mind. And I also think that it's not necessarily the level of the interest rate right now. Like people say, oh, they're like, interest rates are 8 to 9%. They were 20% before. Well, it's the fact that they increased them so quickly in such a short amount of time. I mean, look at these recent bank collapses, right? You just had like the biggest bank collapse with Silicon Valley Bank since Washington Mutual, in like 08, 09 timeframe in the GFC. And so, I mean, that shows you it's affecting the economy overall when you increase the rates so quickly in such a short amount of time. And so I think you have to kind of look, what is the context of the economy and the time we live in with everything.
That was such a great analogy. I love that. And I think it's evident that you're not letting these uncertain times or this changing environment hold you back from doing deals and really just continuing to move forward in your business. And a recent LinkedIn post I saw was that you did a 360 unit multifamily deal in Dallas, Texas. And at the beginning, you mentioned that you guys are moving into that market and are establishing your presence there. I wanted to do a brief case study on that one deal because I think it'll be an awesome, like I said, case study of how you're navigating the debt market right now and making deals happen even in light of the changes we're experiencing. So, can you maybe explain how you found that particular deal and what were some appealing factors of that opportunity?
Yeah, that deal, it was called Point Loma Woods. It's now called Rise Bedford Lake, and we sourced the deal through a broker relationship off market. And so basically, what happened was in November of 2022, we realized, we've had investors reaching out to us saying, hey, we like investing with you guys. We like the reporting, the transparency, the performance of operations. But a lot of these investors have literally invested in 10 or 15 different deals. Okay. And they were all in Phoenix. And they're like, we love Phoenix. We love you guys, but we want to be diversified. When are you going to go to another market? And we've been telling people for 2 years now, we will expand to a new market, but we want to make sure when we do so, we have all of our systems and processes built out. We have all of our infrastructure in place. So when we expand, we can do it responsibly and kind of emulate the same business plan. So November of 2022, we realized as far as our supply chain, our ability to bring up our new property management platform, all these things that we could replicate that model in Dallas. And we saw what was happening in the market where most of the institutions are on the sidelines, most of the syndicators cannot raise money. There's not a lot of competition. So we realized, hey, we've got like a 6 to 12 month window here to enter what has historically been one of the most, if not the most, competitive multifamily markets in the country, Dallas, Fort Worth. And we can go in there and start to build scale. And the goal is, you want to have, when you have vertically integrated property management, you really want to have at least 2 to 3,000 units, for it to make sense and get the economies of scale. So we're like, you know what, let's go in it and let's pound Dallas right now because there's not a lot of competition, and we can get deals at discounts from distressed sellers. Okay, and just the fact that interest rates go up. So, like I said, when interest rates go up, buyers have less purchasing power, values go down, cap rates go up. You can buy deals for a better basis. And so, I mentioned now is not a good time to sell, but it is a good time to buy if you can find the right deal. It's still a needle in a haystack. Okay, so to answer your question, Kerwin, in November, what I did is I reached out to all the top brokers here in Phoenix, and we've worked with all of them, most of them multiple deals. And I said, hey, we're going to Dallas. Can you refer me to your top colleague in Dallas? And these are all the same firms, right? It's like CBRE, Marcus and Millichap, Northmark, Berkadia, JLL, Newmark, et cetera. It's the same groups. And so they were like, yeah, of course, like you guys have been great. We like working with you. So they refer us to all their top guys in Dallas. We go out there and meet with all these guys and we say, hey, this is who we are. And this is what our plan is. We've never retraded. We perform. We have 100% control. And most of them had already heard of us and they appreciated, the endorsement by their colleague in Phoenix. And so they started sending us off market deal flow. Okay. And so, we sourced this particular deal that you're talking about off market through a broker and who we referred to. And we met with him in November. And basically, it was a scenario where there was going to be an interest rate cap coming up to expire in 2023. They wanted to try to get out of this deal early, be proactive. So we got the deal at a really good basis, 360 units. 100% classic interiors. We can renovate all of those units. We can do everything we typically do as far as exterior amenities, improve operations, and in a really good location. And to give you an idea, like the last 5 years or so, Kerwin, when the market was strong, there was a lot of deal flow, but a lot of competition. So it's a needle in a haystack to find deals that work because everything gets bid up. Now there's not as much deal flow, but there's not as much competition. So it's still a needle in a haystack. And so I don't remember what the statistics were at the time of us buying that deal, but I can tell you, um, we're about to do a deal right now, and we just updated our statistics from November of 2022 until now, which we're recording this like what, second week of July, mid July. We've underwritten over 190 different deals in Dallas Fort Worth. They're all sent to us from brokers. And a lot of them are like not real, you know what I mean? Like sellers just kind of floating them out there at a price that's never going to happen, but a lot of them are people that want to sell. Across those 190 plus deals we've underwritten, only 5 of them have worked in our model. 5 of them that we can get to the price the seller wants. And pretty much all of them have some type of pressure that they need to get out of the deal or their motivation to get out of the deal that would motivate them to sell at a lower basis in this environment. Okay, that's a 2% hit rate. 2% of the deals we've underwritten have worked. On average, we're 19% below the purchase price that the seller wants. That's just on average. Okay, so it's a truly a needle in a haystack because you're fighting high interest rates, and so you have to get a much lower basis, a much higher cap rate to be able to make the deal work. You need to have value add. So we need to be able to find that there's a delta between the current rents at that property and what renovated product is achieving nearby, a big delta that we know we can renovate to and conservatively increase rents to. And then you got things like property taxes, in Texas are crazy and they keep going up. So you have to assume these massive increases in property taxes in your year one pro forma from what the seller's paying. And even more drastic has been insurance costs, right? So insurance costs are increasing significantly as well. And so you have to talk to multiple insurance brokers before you even make an LOI. You have to be able to reach out to these brokers and people you have relationships with and get quotes and try to figure out what to model out there. So in November, we met with all these consultants, property tax consultants, insurance consultants, debt brokers, all the investment sales brokers to figure out, okay, let's fine tune our Dallas model because you have to underwrite deals differently in Dallas than you do in Phoenix. So we have, 2 separate models. And so those are the biggest 3 obstacles is the insurance rates, interest rates, insurance, and then property taxes. Okay, those are the biggest things. So yeah, with this deal, we were able to get at a really low basis. I won't go into the price just because Texas is a non-disclosure state. But it was 20% or more discount from what it would have traded for last year, which is why the deal made sense. And so yeah, we're really excited about that investment.
Yeah, I appreciate that breakdown. And it's no secret that debt is a major factor when it comes to doing these kinds of deals. I wanted to know what was the financing, whatever you're able to disclose. What was the financing on that deal, and how did it make sense in the current environment we're in?
Yeah, good question. So I didn't look at it right before this, so I don't want to give you the wrong data, but it's a debt fund bridge loan. So the debt fund is like a publicly traded REIT. And basically, what we do is and to give you some context, we've purchased 44 deals now. We've done a combination of 10-year Freddie fixed rate, we've done 10-year Freddie floating rate, and we've done debt fund bridge loans. We know all the pros and the cons upon acquisition, throughout operations, and across the 11 deals we've sold all 3 types of those loan products. Okay, and multiple of each product. So we know what the prepay penalties are as well on the back end. And so to give you an idea, In earlier one of our earliest deals, we made the mistake of doing a 10-year Freddie fixed rate loan. And a lot of people think that and they think, oh, Zach, you're an idiot. You guys are reckless. You don't know what you're doing. Like, you should only be putting fixed rate debt on these deals because of interest rate volatility. And to do otherwise is irresponsible. Well, a lot of people don't realize that when you do a fixed rate loan, there's a trade off there. Whether it's a bank or an agency with a fixed rate loan, they have exposure because they're guaranteeing that your rate won't change. And if rates go up in the market, they have to cover that. The way that they cover themselves is they hit you with a really nasty prepay penalty called yield maintenance or defeasance. Okay, so for example, you buy a deal and it's a 10-year, Freddie fixed rate loan and you sell it after 2 years, you have to pay them the yield they would have made over the entire 10 years as if you owned it for 10 years. So as an example, and we learned from experience just because we didn't know at the time, we bought a deal in 2019 for $17 million. It was like 137 units, I think. And we put a 10-year Freddie fixed rate loan on it. We get through 50% of the renovations, 2 years, and we exceed the pro forma rent significantly. So in 2021, 2 years later, we go to sell it, and our yield maintenance prepay penalty was $3 million. $3 million of cash right off the top out of investor pockets. So we're like, oh crap, we actually need to hold this deal longer, keep renovating, increase the NOI even more so that when we sell, we can net out a number that absorbs a massive prepay and still net out the investors over a 2x return. Okay. And we were lucky the market was strong because we might not have been able to get out of that deal because the problem is with the nasty prepay penalty, because it's so significant, by the time you go to sell, it bites into your proceeds, your investor returns. So your net final return may not look very attractive to the LP. Or if you're trying to do a refinance, that prepay penalty to pay off the first loan and get into the next loan can be so significant that it bites into your loan proceeds of the new loan, and you might not even be able to refi. And so I think that the fixed rate long term debt product is a great debt product, but you have to align it with what your strategy is. I think if you're doing like newer Class A, 10-year hold, it's a 7 to 10 year hold business plan, and you're not going to be pushing rents or doing like a value add plan. You're just going to, it's more of a yield play. By all means, I would put, 10-year fixed rate debt on it. It just makes the most sense. But if your plan is to go in there, renovate units, force appreciation, increase the value, increase the operations and revenue, I don't think that the fixed rate debt is the best option because you get stuck and you get locked in. You could ace your business plan. You could renovate 100% of the units, exceed your pro forma rents. You still might not be able to sell or refi because the prepay penalty is so significant that you get locked in there. So, we started to pivot to Freddie Mac floating rate loans, which is a little bit better with Freddie Mac floating rate. Basically, how it works is it's a 10-year term. You buy an interest rate cap, but Freddie Mac does not finance your renovation dollars. Okay, so you have to raise 100% of your renovation dollars up front from investors, and you have all this cash sitting in a bank account. And some of these deals, the plan is to renovate 100% of the units, right, and sell in year 5. But on some of these deals, you might renovate 30%, 50%, and you can sell early and get a good return. Well, meanwhile, you have all this cash sitting in CapEx that you raised up front, and every dollar I raise, I have to get a return on it. So with those Freddie Mac loans, it actually was diluting investor returns. We have to raise all the CapEx up front. The reason we like the debt fund bridge loans is that these are 3+1+1 loans. So it's a 3-year term with 2 1-year extensions. And the way that we mitigate against it's floating rate debt and it's interest only for the entire period of the loan. The way that we mitigate against the floating rate risk is that we buy an interest rate cap. We buy a low interest rate cap. So right now, and we've always bought 3-year caps. Okay. So right now we're buying caps that our max all-in rate is between 4.75 to 5%. So for the deal that you're mentioning, I can't remember if it was 4.75 or 5 because we've had a couple that are 5. Most of them have been 4.75, but we're doing an all-in max interest rate for 3 years where no matter what happens in the world with the Fed, the indexes, the treasuries, our all-in rate cannot exceed that 4.75 to 5% for the first 3 years. Okay, so it's kind of like when you buy a single family home, how you can, buy down the rate, right, on the front, or you can buy points. This is effectively what you're doing is you're buying this. It's almost like an insurance policy. Okay, you're buying an interest rate cap from a third party company, and you raise the money to buy the cap up front from investors as a closing cost. So it's part of the total capitalization. And these caps are expensive. They're anywhere from $1.5 to $3 million, right? So you're going to build it in on the front end to buy this cap as a closing cost. And if the deal still pencils with the expense of buying the cap on the front end with our conservative assumptions, then we feel confident knowing our interest rate cannot change for the first 3 years, and we can actually underwrite the prepay penalty on the back end in the model. With yield maintenance, you cannot underwrite yield maintenance. It's impossible because it changes daily. It's like a market, right? So you can't underwrite it. You don't know what it will be by the time you go to sell. So it's a big unknown factor in your model, especially if you're trying to do value add, right? And the goal is to add value and then sell or refi in 5 years. You won't know what that will be. So with this, we know we'll have little to no prepay penalty. Most of these lenders, they want to see 12 to 18 months of total interest payments as the prepay penalty. So if you own it for 18 months or more, you can sell or refi with no prepay penalty whatsoever. Okay, some of these lenders have had no prepay penalty. And so it gives you more flexibility to sell or to refinance. And so some people will ask, well, okay, well, it's a 3-year cap. What happens when your cap expires? Then what do you do? So there's a few options here. Okay, so the first option and most likely is that in our model we're saying that even if rates do not come down 3 years from now, so let's say it's summer of 2026, okay, and rates have not come down, we feel confident that at that deal we've renovated the units, executed the business plan to increase the revenue, increase the NOI, so that even if rates haven't come down, we've increased NOI enough to qualify for more loan proceeds to refinance before the end of year 3, pay off the first loan, and you can use the loan proceeds of the new loan to buy a new cap. Okay, so that's the first option: is you increase NOI, you can refinance, buy a new cap, right? Which is what we're focused on doing for our 2021 deals right now. Okay, to refinance next year for 2021 acquisitions, because those 3-year caps will expire in 2024. Second option, if you can't refi, then these loans are 3+1+1. Okay, so they'll have most of them have some type of testing covenant, like you have to be at a certain DSCR or certain debt yield in order to qualify for the extension. And so in the model, we're looking to see, okay, we feel confident we'll be at the DSCR and or debt yield threshold so that we can extend if we need to year 4, year 5, and then use cash reserves that we've raised at the property level in order to buy another cap. Okay, to get yourself more time. So that's the third option. Or second option is that you can, extend, buy another cap. Third option is you could sell the deal before the end of year 3, which we're not banking on or relying on in the model. But if rates get cut, then it could be realistic. Values will go up, and you could sell the deal. And so we like to model it out so we have a lot of different options, right? So that we can adapt and pivot to whatever makes the most sense according to current economic conditions. But I think the bottom line is that if you're going to do these value add deals and you're going to use floating rate debt, you need to be proficient renovating units. It's extremely critical to be able to renovate units on schedule, on budget, increase the rents, force appreciation. Okay, because if you can't, then you can get in a lot of trouble, right? And so if it's just a long-term hold, by all means put fixed rate debt on. But that's kind of how we're doing these deals, is that we're basically taking low leverage loans. And again, I'd have to look at that deal, because we've bought deals this year that were anywhere between like 58 to 70% loan to value. We've always been a lower leverage group. We've typically always been 60 to 70% loan to value. We have some deals that are as high as 75% loan to value, is the highest leverage we ever took. But our average loan to value right now across 32 assets upon acquisition is 68% loan to value. So we take lower leverage loans. We raise significant cash reserves at the property level, so you have liquidity, which is not allocated to anything, by 3-year interest rate caps, and then we're able to renovate units to increase NOI. And so that's kind of how we're structuring the financing right now. And I can't remember if I mentioned this, but a lot of lenders right now are not taking on new borrowers. They're only doing repeat business because of the volatility. Or if they are new, we've had a couple lenders that we worked with for the first time this year. They're going off your track record and historicals of renovating other units and seeing if you're on schedule, on budget, and they look into your infrastructure. And so you can't even get a loan right now if you don't have some type of track record or capability. It's not like these lenders are going to just give you tens of millions of dollars if you're not performing. And we're having multiple lenders come to the table each time we go out with our debt broker, because basically the process is, Kerwin, is that each deal we engage a debt broker, okay, and then they will give them the underwriting model, the business plan. They will go out to like 50 to 100 lenders depending on the deal, and we get these lenders to review the deal, and then you'll get a group of them who are very interested, and then you start to negotiate and kind of bid them against each other to give you the best terms. And we probably worked with at least, I don't know, 10 to 13 different debt funds. And then we've worked with Freddie Mac as well. So we've worked with a lot of these groups, and these are massive groups like Starwood Capital, the big hotel company. They're one of the largest owners of multifamily in the country. I mean, people don't realize, Brightspire, Rialto, some of these big publicly traded REITs. And so these are our lenders that we're working with, and they're making sure that, hey, we have other deals with these guys that are performing, and we'll do another deal with them.
No, that's awesome, and there's a lot there I kind of want to unpack, but you mentioned I was going to ask you about your underwriting and the assumptions you're making and how you're kind of navigating the environment. So I'm glad you addressed some of those. I know a lot of people you touched on the criticism that some people have regarding bridge debt, and I know a lot of investors have the philosophy that they're sitting on the sidelines right now. Um, and one of the factors you touched on was the type of debt. And so I wanted to know, like, what are some other factors that you think are contributing to a lot of people choosing to sit this one out right now? And why aren't those factors that maybe you didn't mention, or if you want to expand on any, why aren't those factors preventing you from doing deals right now?
Yeah, good question. I mean, there's multiple factors. One is that it's so hard to find a deal that makes sense. And I mean, I don't have data to support this, but I wouldn't be surprised if we're underwriting and cranking, as much or more deals than anybody in Dallas, because we just constantly are cranking the underwriting process. We have a full team where our acquisitions manager Brady and I are talking to brokers every week. I talked to a broker yesterday. I missed a call this morning from when I got a call back, and they're constantly sending us deals. Most of them we can't even get close on, but we go through the process every time, and we do it for a couple of reasons. One is because every time we go through the process, well, first off, we have to go through the process to see if the deal pencils, right? To see if it's one it's a good opportunity. But it gets discouraging because you're just constantly banging your head against the wall and you're underwriting these deals. And every single deal, we're having to get property tax projections from our consultant, insurance projections. We're having our team shop the comps, like our local asset manager in Dallas, to see if our pro forma rents are conservative and achievable. And then, we're having to size debt, and it's just, it's a painstaking process. But we've got Oren on our acquisitions team who's doing the initial underwriting, plugging in the data and making sure everything looks right there, and then Brady will fine tune it, and then Bikron, our CFO, will do the final look at it, make sure, and he usually like makes it even more conservative, cuts it back, and then if it's even close, then Bikron and I will look at it. But we're also doing this process every time to give brokers detailed feedback so that they know they're not wasting their time with us. And that only strengthens the bond, because when a broker sends you a deal and you just say no, you don't give them feedback why, they don't have any insight, and they don't keep sending you deals. They just don't take it serious. But what we do is we type out like a detailed summary, and we show them all of our assumptions. We say, this is our assumptions for organic rent growth. We have to spend this much on the cap, et cetera, et cetera, et cetera. This is why this deal doesn't work. This is the max price. And like sometimes you feel bad, especially in Dallas, because we were new to the market. Like I don't know these brokers as well, and I have to keep delivering bad news, right? Like, hey, thanks for sending me the deal, but can't get close on this one either, or this one, or this one. And so we decided to start sending these detailed summaries, and a lot of them reply back and like, hey, I really appreciate this. I'm going to give this to the seller because the seller has unrealistic expectations, doesn't understand what's happening right now, and I appreciate that you guys actually took the time to look at it. And so with the brokers, it's all about like politics. Like you have to manage these relationships. You have to show them that you're going to perform. You have to be responsive, and it's all about track record, because the brokers are the gatekeepers. Okay, they control the deal flow. And if you piss one of them off or you burn somebody, you'll get blacklisted because there's other buyers out there, right? And so that's a big part of it, is broker relations. Go ahead.
Earlier, you mentioned that a lot of the sellers, you're averaging 19% below what they're asking. And a lot of people have the sentiment where right now, if you buy a deal, you have the potential of catching a falling knife. A lot of people think that they're afraid of overpaying for an asset right now. So I want to know, like, where do you think we are in the market, and how are you confident that you're not overpaying for the assets?
Yeah, good question. So, I mean, we stick to our underwriting assumptions. We have our model. We're using 0% organic rent growth in year one, 3% organic rent growth year over year over the 5 years, referencing CoStar data for exit cap rates. We shop all the comps for pro forma rents. We feel confident about the cash reserves that we raise. So we stick to our conservative underwriting model, and we feel like if we use these assumptions, then this is the max price that we can pay, and we feel like the deal works. And so we'll offer the max price that we can pay in the model, which is typically well below, so it's not like we're like speculating or, it's like a shot in the dark. We have a full process with assumptions built in, and, the deal has to fit that criteria. Okay. And so, and cap rates haven't really expanded a lot the last several months. I mean, you kind of saw them start to slow down, like really end of Q4, Q1. You didn't see as drastic of increases. And like I said, the deals that we're buying, they've got interest rate caps that are expiring. Like we bought a deal in Dallas where their literal balloon payment on their term was going to expire the next month, and they had to get out of the deal. They were truly distressed because they couldn't refi out. And so, yeah, people can say you're dropping a falling knife, but at what point are you getting a good opportunity? You know what I mean? And are you buying a distressed asset? Because I can tell you this: 2020 when COVID hits, right? And I'm not going to compare this directly to COVID because we don't know, how this turns out. But just as an example, 2020 March, COVID hits. We're freaking out like everybody. The sky is falling. By July, we're like looking at our portfolio, like, wait, everything's going pretty well. We're actually getting a lot of growth. So we quietly started tying up deals off market the second half of 2020 when nobody else was buying. We got them at great basis, and then we were able to sell all those deals the next couple of years. They were home runs. So like I think it was like 4 or 5 deals because there was no competition. There wasn't a lot of people buying. And so right now, there's no debating these deals are at least 20-30% less than they were last year that we're buying. So you're getting deals at a great basis when other people are scared to buy deals. And for us, you know, people probably think, well, you're irresponsible, reckless buying these deals. Well, we're finding good opportunities. Like this is when it is time to buy, when there is distress in the market and you're buying deals at a good basis. And so, yeah, that's kind of our perspective on that.
Yeah, I love that. There's a lot of talk in the mainstream media, and a lot of economists are kind of like speculating that there's this looming recession coming. And I believe you started your real estate journey in 2019. I know we started in 2020, so not too long after you, but we never experienced an economic downturn. And so I imagine, or I don't know, I would love to know, have investors been cautious with you in regards to the fact that you haven't experienced an economic downturn? And if so, how do you kind of overcome that objection?
Yeah, great question. So yeah, no, it's always a question, 100%. It's you're a newer group, you don't have as long of a track record, you haven't been through a downturn. And really the last downturn hasn't been since 08, 09. And so there's a lot of operators right now that have not been through a downturn. Really since like 2012 till now, 10 years, things have just been going up and getting better. And so really it comes down to referencing historical data, using conservative underwriting assumptions. Bikron's our CFO. So he's the final, the buck stops him for underwriting. His background is an economics degree, CPA, worked at Price Waterhouse Coopers, for a number of years, one of the big four accounting firms, as a corporate auditor, auditing Fortune 100 companies. And when I first met Bikron in 2018, because we really got started in 2018, but it took us over a year to close our first deal. 2018, he's like, Zach, as a corporate auditor, I saw like under the hood into the financials of the biggest companies in the world. And whenever they fail, it's because they don't have enough liquidity. And so that's one of the big things, is to make sure you have liquidity, make sure you have conservative rental growth assumptions, and to make sure you're structuring your debt in a way that gives you flexibility. And so, like as an example, we bought a bunch of deals in 2021, and we have 3-year interest rate caps that will start to expire in 2024, right? So right now the emphasis is increase the velocity of renovations to increase rents, increase NOI, increase the DSCR, so that by the time those caps come up, we're in a position where we can refinance into new loans. And we're confident we can do that, and we're on track to do that. And so, yeah, I mean, I think that it's a great opportunity to be able to prove yourself as a firm, because I've been telling people, you get through the next 24 months as a real estate company without doing a capital call, without a foreclosure, you don't lose investor money. Most of your competition is going to wash away, and you're going to come out on the other side and be able to experience exponential growth after that, because you were able to prove that you did get through a downturn, right? And so basically, the primary focus is on operations. I spend most of my time in operations meetings each week, and we're always looking at, construction, leasing activity. We have training classes for our new hires. Like yesterday, we had our new class that started this week, and I'm in the training class and introducing myself and greeting these people. And so I think on the outside, people see us and they say, "Oh, Rise 48, those are just some young guys who haven't been through a downturn. All they're doing is buying deals and collecting acquisition fees. They don't see what happens every day. Where like I'm in our office right now. This is a 21,000 square foot building that we own. Like the three of us bought it ourselves last year, and we occupy the entire thing. Okay, and the building is full, and we have staff that comes here every single day that are in asset management, financial planning and analysis, tax, accounting, marketing, investor relations, collections, corporate leasing, training, HR. We don't allow remote work. Okay. So we've got a full team here every day. We have a full time team in the Dallas office, and then we've got full time teams in both markets that are out in the field. So, I think there's a lot of misconceptions and negative press right now about around syndicators. I think they need to realize not all groups are created equally. It's not like I'm sitting in my basement, raising money from investors playing video games. And I show up to this office. I'm usually here at least 10 to 12 hours a day. You know what I mean? So like we're a fully built out organization focused on this. And yeah, right now the biggest focus is you have to renovate these units, force appreciation to get your NOI and your DSCR up before interest rate caps expire. Our first cap will not expire until June of 2024 on a 2021 deal. And then they start to expire after that for second half deals that we bought in 2021. The deals that we're buying this year, those will expire in 2026. And so that's kind of, the focus from the operational perspective.
Yeah, I appreciate your transparency. I know I've come across a lot of negative press relating to the syndication space recently as well. And I know, so you've accomplished a lot in since 2019. You've built a nearly $2 billion real estate portfolio, multifamily portfolio. And I know a lot of people would criticize you, kind of claiming that you've scaled so fast and that's not sustainable, or just criticizing the speed at which you've scaled. What is your response to that criticism?
Yeah, good question. I mean, I understand it. Like, I don't blame people saying that from the exterior. They say, okay, you guys are new, you're reckless, but I think they just don't realize how we've done it. I mean, if you look at it, we've bought 40 deals in Phoenix. So like all of our deals are within like 30 to 40 minutes of each other, and we did everything in house. And so when you stay focused in that one niche where you can rinse and repeat and create systems and processes and create scale, you can exponentially grow. It's not like we're spread out across the country in all these different markets using third party management. We bought 40 deals in Phoenix that are all around each other, and a lot of them are in the same sub markets, and we're doing the same exact business plan over and over, rinse and repeat, right? And so, I think that there's a ton of syndicators across the country, hundreds of them, if not, I don't know, over 1,000, I have no idea. And a lot of our investors have invested with different groups across the country, right? They have options, they have the internet, they can find different people. The biggest reason we've been able to scale is because we have very transparent and high level investor reporting. And every single month, they get everything. We upload the entire financial package into the investor portal every single month. So every investor literally has access to bank statements, mortgage statements, balance sheet, the general ledger. They can see every single accounting entry for that property. So we literally couldn't be more transparent. And then in the executive summary, which is about like a 9 to 10 page monthly report, it shows them these are our updates on the renovations. We renovated X amount of units. Our average increase is X. This is the progress on the CapEx items. Here is the 1 month performance versus budget. This is how much cash reserves we have at the property level. This is our max interest rate cap, which we've hit. This is when it expires. And so they have that full transparency. They're seeing in real time the operations,
Mhm.
and we've gotten feedback. This is not to just paint a wide brush, so to speak, and make a generalization. But we've gotten feedback from a lot of groups or a lot of investors that other syndication groups, don't have, as high level reporting or transparent reporting. And so I think that, the demand from investors speaks for itself, because, ultimately, they're kind of shopping with their dollar, so to speak, just like with any consumer and any product. And obviously interest rates shoot up so quickly, it has a negative impact, right? And I think that there's groups that are much bigger than us. We're like a tiny little ant compared to a lot of these groups, and that have been doing it much longer than us, who are collapsing right now. And they've been doing capital calls for several months or even last year, and are in a lot of trouble. And we're not in that position, right? And so people want to group us in with that and say you're reckless. They want to pull data from third party loan reporting agencies from the end of 2021 that or end of 2022 that shows our DSCR is low. This is no surprise to our investors. We show them this data every single month. They already know it, and we explain it, and we do webinars to show people, hey, we bought a deal, and and then when we bought the deal, our interest rate was here, our NOI was here, and we have an interest rate cap up here. We built and as a side note, we've always built at least 100, 200 basis points of interest rate expansion into our model over the first 1 to 2 years. Even this was when hardly anybody was doing that. Obviously, it wasn't enough because we didn't know rates would shoot up. But basically, in the model, we're saying our NOI is here, and we're projecting it stays like this. Well, what happened in reality? The debt service shoots up to the cap, right? Like that within 12 months or less. And so now you're negatively cash flowing because your expenses and debt service are higher than your NOI. Well, the benefit that we have over a lot of other groups who are in trouble is we took lower leverage loans, so we don't have as much debt service. We have more cash equity. We always raise significant cash reserves at the property level to cover this delta, okay, in the short term. So cash reserves can cover the delta of negative cash flow. Meanwhile, we've increased the velocity of renovations to increase rents, increase NOI to close the gap. Okay, so for most of these deals that are below a 1.0 DSCR negatively cash flowing, we project by Q1 of 2024 they'll be positively cash flowing because we're seeing the progress already. The first 6 months of this year by cranking renovations, and then because the cap can't go any higher, the rate is there, right? And then we got to keep going up to like a 1.25 DSCR and start doing refinances. So that's the plan, and we're very transparent with investors, and they understand because they're literally getting hit with capital calls from other syndicators that they work with. We've never done a capital call, and we've been communicating all year. We don't plan on doing any this year, next year, or the foreseeable future. And it's because of these forecasts that we have and the way that we structured the debt.
It's clear that you guys are really well positioned. And you did touch on my next question, but I still want to see if you have anything to add. There's this investment adage that every investment involves risk, and you touched on some ways you're mitigating risks. But I wanted to maybe see if you have anything to expand on in regards to, are there any risks that you're taking, and how are you mitigating them?
Yeah, no, yeah. Every investment has risk, right? Whether you're investing in the stock market, you're flipping a house, there's none of us have a crystal ball, right? So we do the best that we can to mitigate against risk. And I think some of the things that we do, I've kind of talked about, where we're taking lower leverage loans, we're buying 3-year interest rate caps, we're buying lower caps, raising cash reserves, we're making sure that we have infrastructure to renovate units on schedule, on budget, and push the rents. Those are all things that we have in place. The assumptions in the model also help mitigate risk, right? By assuming 0% organic rent growth in year one, by shopping all the comps and making sure you don't have aggressive post renovation pro forma rent. So, all of these things are part of the stress test in the model to try to mitigate against risk. And I can tell you that once it was evident, really like in Q2 of 2022, that these were going to be consistently long, relentless rate hikes, we adjusted our model around that. Okay. So in 2021, we were still buying 3-year caps. We were still raising cash reserves. In 2022, we started buying even lower caps, raising even more cash reserves. Okay. Because now you know what's going to be coming. And so for like newer acquisitions, you adjust your model, right? And you can adapt to that. And so, yeah, it's all about adapting and doing things like that. But yeah, I mean, there's a lot of different things that we put in place to try to mitigate against the risk.
Yeah, Rise 48 is quickly becoming a leading group in this space. I've heard you guys mention at multiple conferences, and my brothers and I personally really look up to you and what you're doing. And you just really provide an awesome vision for what we aim to hopefully accomplish in this space as well. And so I want to know, what is your long term vision for Rise 48?
Yeah, good question. So basically, this might sound kind of ridiculous, but our goal is to be the largest and most successful real estate firm in the world. Okay. And so we like doing the syndication, and we really like that part of it. So we want to have that syndication arm. Um, Down the road, we'd like to have like large institutional funds where we're raising money from like endowments, state pension funds, things like that, to buy larger assets and more volume across the country. But that could be, 10, 20 years down the road. Everything that we're doing right now is focused on performance, building track record, building infrastructure. And so, that's why I tell investors, it's like, hey, we're not like some transactional company that's trying to close a deal, earn an acquisition fee, and disappear. We're building this company for the next 30 to 40 years, okay, to be a dominant force in the industry across the country. That's our goal. And that's why right now it's such a critical period, because everything that we're doing right now is based on our reputation and track record for future growth. And we know that, once we get through this tumultuous time, and you don't do capital calls and you're in good shape, you're really going to separate yourselves from competition. And so I know some people might think, oh, you guys grew so fast. I mean, honestly, like, it feels like we've been doing this for 10 years. So, like, when people say that, it doesn't like, because it's like so much things have changed and we're just constantly grinding. And this is what we love to do. Like this is what we do. This is my life. This company is my life, and this is what I'm passionate about. I can't go on vacations. I get bored, I'm like, get anxious. I'm like, what's the point of this? So this is what's fun. We like the challenge. And we feel like we haven't achieved anything. You know what I mean? We feel like we have a lot to prove, and then a lot of areas to improve and learn, and we're always trying to do that. And so, that's kind of where we want to go, is, be much larger. And but also it's all about performance. And so it's like, you have to get the results, because we realize without the results, it's not going to happen. So that's why, as we've sold deals, as we earn acquisition fees, we invest it back in the company as infrastructure. We cover 100% of all of our employees' medical, dental, vision, 50% of their dependents. We have a 401k program for everybody. We match 3% of their contributions. And so we're building infrastructure and a core team that can help us to, responsibly scale and do things the right way. And yeah, if you're interested in kind of learning about what we do, you can go to our website, rise48equity.com. You can set up a call with me or somebody on our team to kind of learn more about it, to learn about future opportunities. You can email me, Zach, ZACH at rise48equity.com. So thanks so much, Kurt. I really appreciate it.